Hello, my name is Ross Polking, lead advisor here at Foster Group. I've been with the firm for 15 years, currently one of our shareholders and sit on our board of directors. Topic of this video today is sequence of return risk. It's a relatively unknown financial planning tactic and tool. So I want to start off with a story to better describe what we're talking about. This here is a picture of the deck off the back of our house. And we've been needing to do some work on this deck for a number of years. Been procrastinating a bit, other higher priority projects, and I also don't like to spend a whole lot of money. So this past winter was difficult from the amount of snow we received. So after everything melted off, we knew we needed to get something done ASAP. And as most of you know, lumber prices were much inflated this past year. So the project as a whole cost us a lot more than originally anticipated. So this is a good example of sequence of return risk. The fact that we waited to initiate a project and market conditions outside of our control really negatively impacted the financial circumstances overall. So not unlike the decision on when to enter retirement, other risks exist. Most of these we're familiar with: longevity risk, the sustainability of a portfolio, inflation, tax, market volatility. Sequence of return risks exists just the same. So let's start with a definition. And this is a risk that an investor will experience negative portfolio returns late in their working lives and or early retirement. So this picture here below, this graph, is a very simple example of what our lifetimes look like. First, we accumulate assets up to a point of retirement, and then we go into a phase of distributing assets to supplement our lifestyle expenditures. There's a danger zone there in the middle, though, and that danger zone is market performance and what that's doing to the assets that we've thus accumulated over the course of time. Here's a good example to help reinforce the point of sequence of return risk. So we have Jane and Jim, both starting with $500,000 in their portfolio, both retiring at age 66. We run these scenarios out 15 years. Both are taking the same annual withdrawal as well. Their returns, however, are flipped. So you can look at what Jane is starting with from a return standpoint in her portfolio: -10%, -13%. Those same returns Jim experiences, but in reverse order. So his negative return years are later in retirement for him. Average annualized return is the same for both, but bottom line, you can see the ending balance for Jim is substantially higher than that for Jane. And why is that? Well, it gets back to the topic of this video. It's sequence of return risk. When Jane starts taking her distributions, the hit to the portfolio as a whole is compounded by the fact that the market return is substantially worse than that of Jim's when he is essentially insulating his portfolio for down years later on in life. So how do we protect ourselves from this particular risk? One option is certainly to not retire, which we wouldn't necessarily recommend, nor would many of you probably choose to do. So lots of ways. Two that I'm going to focus on are diversification, so diversifying your portfolio, which we're familiar with. And the second would be a concept we call lifeboat drill. But first, diversification. What this chart shows us here is returns for various asset classes over the last 14, 15 years, representing, again, different sectors of the economy. And it's clear there's no pattern here. So if you look from any year to the next, again, scaled from highest return to lowest return, what you can see there is, and that being if sequence of return risk is being played out here, if I'm an investor and I'm retiring in 2020 and all of my investments, an extreme example I know, but if all of my investments are in the Dow Jones US Select REIT Index, getting a negative 11% return in 2020, I'm going to have some risks similar to what Jane had. I'm going to be pulling money out of my portfolio all the while my portfolio is succumbing to a negative performing year and maybe others in the future. So the idea behind diversification is to smooth out the ride and dampen volatility, and thus making sure we're investing across the spectrum of asset classes and not just concentrated in one specifically. This is yeah, I like napkin and drawings. This is a simple example, again, reflective of the importance of diversification. So if I'm on the left there, if I am solely invested in ABC company stock versus the individual to the right there, who's in a much more diversified portfolio, they may have ABC company stock represented in there, but at a much smaller scale. The risk certainly exists for the individual only holding that one company stock. Just imagine being that individual who's on the verge of retirement and all of their dollars are invested there with ABC. And shortly thereafter retirement, bad news, bad market conditions, whatever the case may be, negatively impact ABC, and their stock shares are cut in half from a value standpoint. That was meant to serve as a distribution source for the individual there in retirement. And now all of a sudden they're drawing upon assets that are half the value that they intended them to be as they entered retirement. So diversification, incredibly important as one nears and or enters retirement. The second concept in mitigating sequence of return risk is what we call the lifeboat. So think about what a lifeboat does. It gives you a safety net, essentially, if the market is negatively performing. So relative to your portfolio, what is it that would hold its value in the event that maybe your stocks, your equity exposures would have a bad time period? Think back to last year, February and March of 2020. The market fell off a cliff. Those who were in distribution mode, the last thing they wanted to do was pull money out of their stocks and instead tap into what we would call the preservation side of their portfolio. So simple example here of a typical maybe portfolio from 30,000 foot view standpoint, some sort of blend between preservation and growth assets. So growth assets represented by the blue side of the portfolio here, stocks, funds, ETFs, etc. Those that would be much more volatile than what we have on the preservation side of the portfolio, this 40%, where you would have bonds and CDs, cash equivalents of some sort, those that are uncorrelated to the ups and downs, the daily ups and downs of the market. Again, back to February and March of last year, if this was your portfolio, the last thing you would want to have done is sell assets over here on the growth side of the portfolio at much less or much smaller price points. You would rather have gone over to the preservation side of the portfolio to create liquidity for spending purposes. Another way to think about this lifeboat and again, mitigating the sequence of return risk is a bucket analogy. You might have seen something like this before. Really, it's just broken down into strategizing your distributions as you near and or enter retirement. This first bucket here, the smallest of those, is current spending. So think about the next 6 months of spending, making sure that that's held in cash so that if we get a bad day, month, even half a year, you can lessen the amount of panic that you would have if all of your assets were, again, in an ABC stock. Short-term savings would be next. So this next 6 to 24 month time period, having those particular assets, those spendable assets in shorter term bonds, CDs, something that would generate a little bit more return, maybe carry a little bit more risk than cash, but nothing that would necessarily be correlated with strict stock market exposure. Then there's a long-term portfolio bucket. Some fixed income, some balance of fixed income and stocks, but really this is your growth engine. Retirement lasts a long time, upwards of 30-ish plus years. So certainly the portfolio and your assets need to keep up with at minimum inflation. So having some sort of blend there to complement the long-term sustainability of the portfolio. So a natural question is, well, how much do we put in this lifeboat that we're talking about? And this chart is super busy. Really, the moral of the story is, over the history of markets, we've never had a time period where we've gone from peak to trough and recovery that's lasted more than 8 years. Now, 8 years is a long time, but if we use that as our precedence, what we're aiming for with the lifeboat is having liquid assets, again, cash equivalent, CDs, short-term bonds, something outside of the market that supports 8 years worth of spending. So again, if we get into a time period that's unprecedented and negative from a market standpoint, we're mitigating that sequence of return risk. We don't have to go sell stock to buy our groceries and take trips. We can go into the lifeboat side of the portfolio and allow those now depressed equities to recover in value before we start tapping into those dollars. So here's a summation of mitigating the risks that we're talking about. A couple we've already mentioned: the lifeboat, the buckets, diversification. But starting up top there, obviously working longer and saving more in earning years, those are things to think about in advance. Nobody maybe wants to work longer, but it is an option to be mindful of. Eliminate debt before retirement. That just creates flexibility in your cash flow. Not having encumbrances and owing others frees up where your dollars can be spent, or frees up your ability to take distributions if and when necessary. Planning and anticipating worst case scenarios, knowing that you plan for negative market periods in advance will give you an emotional buffer in a period of time where it may be cause for concern. Distribution strategy that's flexible and intentional. Again, this goes back to planning in advance. Avoiding significant distributions early in retirement. If you think back to Jane and her scenario, if she, instead of taking that initial distribution in the year in which she had a significantly negative return, and instead postponed maybe some spending to the following year or following years, that would enable the portfolio sustainability at a longer period of time. And finally, hire yourself an objective fiduciary-based advisor. A ton of emotion, again, comes with managing one's own money. And really the planning component of this is clear in mitigating sequence of return risk. So it's real. It's not to be taken lightly. So plan well, build your lifeboat, stay diversified so you can stay retired. And give us a shout if you'd like to talk about this topic relative to your situation. Those of you who are clients of Foster Group know your team is always mindful of this risk as your timeline draws closer to retirement. And they are actively planning and mitigating the impact of negative return sequencing. So thanks for listening and look forward to hearing from you.